Are you someone that's preparing for, maybe you're already in retirement and you're trying to determine what the best investment strategy is for you over the next 20, 30, 40 years of your retirement? That's what I want to talk about today. I want to talk about a really simple strategy we use here at Carlson for our clients that I think is really easy to understand, but it's also efficient because it factors in the other areas of retirement planning like tax planning and income planning. I think it helps our clients feel very secure about their plan as they navigate through retirement. So that's what we're going to talk about today. If you're interested in more topics like this, go down below, subscribe to the channel, like the video, and then stay to the end. I'm going to have a quiz that you can take that'll help you better determine your views on the market and really your risk tolerance when it comes to investing. Let's get into it. The framework we like to use here at Carlson is what we call the financial house. And what the financial house really is it's just a really simple way of thinking of your investments in three different areas or three different buckets, but three different levels of a house risk-wise, right? So as I draw this house, I want you to think about your current investments and think about where they fall in this house, because sometimes I'll draw this out and people will be shocked because they're either way more in one area than they expected to be or way more in the other than they expected to be. And most of the time they're wanting to find a middle ground there. Keep that in mind as we go through this exercise where I draw out this financial house. So let's get started. You know, every house, every financial house, and really every house ever is going to start with your foundation. And I'm going to apologize now, I'm not a good drawer, but the foundation is what we call your safety. It is the safety in your portfolio, the money that helps you sleep well at night when we see a market downturn like we did in 2022. They're downside protected, but they're also very limited on the upside. So that's why someone that wants to be primarily in the foundation, normally we need to look really hard at that, because a lot of times it's hard to have a successful long-term retirement if you are just completely in foundation investments. Now, as I've been talking, I'm sure you're thinking of what those may be, right? Cash, I think, is a really obvious one. Cash is one that obviously goes down here in the foundation, but also things like money market accounts, even like certain types of annuities, like fixed indexed annuities would go down here. CDs have been a popular foundation type investment here, especially in 2022 and 2023. So again, downside protected, but definitely limiting your upside. So this is the safety of your plan where we think we want to start as we build up your house. But as I've said, we don't want to be completely invested in areas that don't give us much potential return. So we want to start to build up this house a little bit, and we're going to start adding some walls. And so the walls are, we're jumping in, we're probably getting into the market a little bit, but we're not taking the most possible risk. And honestly, what I say a lot of times about wall type investments are, these are going to be investments that maybe aren't totally correlated to the rest of the stock market performance. Now, a lot of times you'll hear bonds are in an area like this, whereas bonds in 2022, they went down as well as stocks, but it was kind of an outlier, right? That's not normally what you see. So bonds would be one of those walls type investments. Real estate, honestly, would be one that goes here in the walls. We really like for our clients the dividend stocks here in the walls, just solid paying dividend companies. Now you're taking some risk, you're looking for some growth, but you're definitely not in the most volatile area of the market. That's where we get to the final part of the house, and that's going to be your roof. And what we're looking at here in the roof is, obviously, I'm sure you've been thinking it, this is your growth. This is the money that from 2013 to 2021 was a really fun time because the market kept going up. Your growth funds, your growth stocks, they were going up too. However, in 2022, they definitely got hit pretty hard. And these are things, as I said, growth stocks, but more specifically, like think Apple, Amazon, Google, things like that, but also like even the S&P 500 you could put up here. These are things that you can see a 20, 25, even more % drawdown in your portfolio. This is where we're seeking growth, but also have to be ready to stomach the volatility. And so that's why we say we don't want to be all in the roof, because that can be really stressful, especially in retirement. That's where a lot of people, during their working years, during their accumulation years, they put a lot of money in these growth areas, which has worked out really well for them. But then they get into their 60s, they hit retirement, and having that much money in the market and in pure growth can get a little stressful just because of those times of volatility. So that's where we start to build out a true plan for this financial house. How do we make those decisions when we're looking at that with people? Let's use a couple different hypothetical situations. Let's say that couple number one, we're going to call them Bob and Mary. And let's say Bob and Mary, they're retired, I don't know, let's call them 64 years old each. Their Social Security is $50K per year, $50,000 per year. And so the reason I'm writing down what their Social Security is, because before we can even start to think about building out this investment strategy, we've got to answer a few really important questions. One, what is their income need? What do Bob and Mary need income-wise to cover their lifestyle every single month in retirement? And two, and really two and three, where's that income coming from is important also. And three, what's their risk tolerance? How much risk are they willing to take? And frankly, how much does their plan dictate that they need to take for it to be successful? So we know their Social Security is $50,000 per year. Let's say they don't have any pensions, and then let's say that they were making more money than $50,000 a year, so their spending was at $86,000 per year in spending while they were working, and we're just going to assume that doesn't change. It's really hard to lower cost, especially in retirement when you've now got more free time, you're traveling more. Sometimes this number actually goes up, but we're going to say Bob and Mary, it's going to stay right there. But right off the bat, what this tells me is Bob and Mary have a $36,000 shortfall every year, which also tells me they need $3,000 a month out of their portfolio. So when I start to build out their financial house, their investment strategy, I know right off the bat that Bob and Mary need a strong foundation, regardless really of how much assets they have. Because if the stock market takes a big hit, if we see a 2008, a 2022 where the market drops by 20, 30, 40%, if you are primarily in the roof and you need income out of your portfolio every single month, well, now we're having to worry about timing the market. We're having to worry about selling stocks when they're down 30, 40%. So these are things we've got to be thinking about as we build out that portfolio. Like I said, and by the way, let's say that Bob and Mary, they have a solid retirement saved of $1 million. So that'll also help us as we build this out. So let's say that we know they need that strong foundation because every single month they need that safe bucket to go get their income from. So let's say that Bob and Mary might have 40% down here in the foundation, because no matter what, they want to go in there and they need to pull that income. But we also know at $1 million and $36,000 coming out every year, and inflation and things like that, we know their portfolio needs to grow too. So we can't put everything in the foundation. So we then may say we're going to put, let's just call it 20% here in the walls, and then that leaves another 40% here in the roof. Now, some may say let's do 60% in the roof and 40% in the foundation, but for this exercise, let's just put them in both areas. And so what the 40% foundation also allows us to do is it allows these growth stocks here, and we can be a little more aggressive in that roof portfolio, so to say, because we know they have that anchor built in down there in their foundation. So that's how someone like Bob and Mary looks. Now then let's look at Pat and Pam real quick. They're gonna be couple number 2. And just to do this as fast as possible, let's call Pat and Pam. They're also 64. Their Social Security is also $50K per year, but they only spend $50,000, and they also have a pension that pays them $36,000 $3,000 a year. So as we're seeing now, right off the bat, instead of having that $3,000 monthly shortfall like Bob and Mary did, Pat and Pam actually have a $3,000 monthly surplus coming in that they don't have as much of an income need because their income's covered from Social Security and pensions, which is awesome. So when we're starting to build out Pat and Pam's plan, and let's say they also have $1 million, by the way, Pat and Pam have a lot more flexibility on what they can do with their portfolio. You know, if they wanted to, they could be much more aggressive. They could go up and say, hey, we want to have 90% in growth, or 100%. I probably wouldn't advocate for that, but if they were really big risk takers, they may say that. But to be more realistic, we may say Pat and Pam are going to put 70% up here. They're going to do 10% here and 20% down here, but really you could flip the 20 and the 10 or however you want to do it. But Pat and Pam, as we know, they can take more risk because they simply don't need as much foundation down there to pull income from every month. Really what Pat and Pam have a foundation for is just to help them feel a little better and help their portfolio be diversified so that a time like 2007 through 2009, right, doesn't completely have them ultra stressed for a 3-year stretch. So Pat and Pam have more flexibility. They can go seek more growth. And honestly, most likely, Pat and Pam's portfolio will perform better than Bob and Mary's, but Bob and Mary cannot risk that 2008 scenario like I've mentioned a couple times. So that's how we view the financial house. That's a really simple strategy that we use here with our clients that you can think about for your situation as well, because I want you to think about your house, and if it's not what you've expected or not kind of how you understood it, it may be time to seek a second opinion or just make some adjustments in your portfolio. So to get a better understanding of what your risk tolerance is, we've got a quiz for you down below that if you go click that link and take that quiz, it's not going to assign you a risk tolerance, right? You've heard moderate, conservative, aggressive, all those things. It's not going to do that. What it does instead is it assigns you a risk score. So a score from 1 to 99, 1 being cash, 99 being the most aggressive, portfolio you could have. 1 is obviously someone that's very conservative, doesn't want to take risk. 99 is someone that's very willing to gamble and take those risks in the stock market. So take that quiz, get an idea of where you fall so that you can make sure that your current plan is in line with really how you view the market. So thank you very much for watching. Like I said, download that, take that quiz. We've got some guides down below that you can download as well. And subscribe, like, and we'll hopefully be back next week with another video around this similar topic. So thanks and have a great day.